Hey everyone, my name is Addy, and I've been selling options for the last 10 years. I know a lot of my audience come to me and then they complain about not being able to make enough money in the options market and it's too tough, too complex. That's primarily because they've been buying options, and I think the math is completely reversed when you are selling options. It's a 70-30 shot. So what I mean by that is if you buy an out the money option at 30 delta, you only have a 30% chance to being in the money and making any kind of money on that. If you are selling that option, you have a 70 reversed in your favor if you're a seller. So my videos are primarily on option selling and how to strategize the whole portfolio and what kind of strategies to pick in which environment, high volatility, low vol, what kind of delta and days to expiration to pick. But that's just the entrance or, getting into the trade. Then the problem is when the market moves like today, it's up like almost 100 points on the E-mini S&P 500. Then what do? You are bound to see that your short strike is breached. So then what do? You have to manage and risk manage and defend that trade and adjust it and mechanically roll the trade out and further to collect more premium. And that's one way of managing your risk in the portfolio. So today my topic is how to actually survive 3 losing trades without losing your mind. And that's a really important topic. People come to me and ask, I've lost 3 or 4 trades in a row. What should I do? How can I not, get discouraged with this market? I want to stay engaged. I want to be in the market, but I keep losing my trades. I need a winning streak to, get my motivation back. So today's video is just about how to manage your losing streak. It doesn't matter if it's 1, 2, or 3, 4, or 5 trades. It doesn't really matter. The 2 important things that I'm going to talk about is risk-defined strategies if you're a beginner or an intermediate trader. If you're an advanced trader, you understand naked options. You understand how to sell strangles and how to sell puts and calls and without any long options or without any risk-defined strategies or without any long legs. Then it's okay. We're not talking about the very high-level complex stuff here. We are talking about beginner level, how to manage your risk in any given strategy and how to actually manage that risk after you are in the trade and the trade has gone against you. So we talk about risk-defined strategies, and then we will talk about how to not lose your mind when you lose the trade, how not to close the trade at the wrong time, always keep an eye on volatility, and and all that kind of stuff. So let's dive in. So we're talking about risk-defined strategies and then diversification in your portfolio. I don't want you to put all your eggs in one basket. By that, what I mean is not all your strategies should be risk-defined. Not all your strategies should be undefined risk. Not all strategies should be, focused on one particular underlying market. It should be spread out. Basically, you have to spread your risk out wherever the opportunity is. You don't have to concentrate anywhere in any sector in any given underlying market. So let's dive into the portfolio and what do I mean by risk defined. So today's market is up quite a bit. And by the way, if you guys are interested, I have a YouTube channel. I'll post the link in the show notes. But more important, I have some blogs written on multiple different topics. I have a free trading webinar. This page is not updated yet, but I haven't put the day and time on it yet. And then there's a 5-day challenge. Again, take a look. It's not live yet. The dates are out. I haven't really put the dates in yet. It's still in testing phase, but take a look at and see if you if you want to dive deeper into these strategies and get your options trading options trading habit, or what do you call it, market engagement going. Let's go into the platform right away and then just talk about these strategies. Okay, I want to keep this video short enough so that you don't get bored of it. So I'm just going to go through it, not that quickly, but just to try and cover everything here. One interesting topic here for me, one market that is interesting me right now is the 30-year bond market. ZB has been down on the bottom because the rates have been high. So when the rates are high, these interest rate products actually lose money because that's how they are designed. That's how they are valued. When the rates are low, these things go up because you divide the cash flow in order to calculate the value of this bond. Meaning, in order to get to that 114.29 that is trading at right now, you need to divide the cash flows with the interest rate. And because of that, if the denominator is a bigger number, the overall value is smaller. And if the denominator is a smaller number, meaning when the rates are low, the overall value is higher. So based on those cash flows, the value is arrived at that point where it gives you that 114.29. Anyway, that was a small snapshot. I know this because I'm a, I've done CFA, 2 levels of CFA, level 1 and level 2. I still need to complete my level 3, but anyway, that's just my 2 cents on this market. So the market is down. Volatility is slightly up. It's not that high, but it's um, it's edging higher. So this is a good time to like get in. It's I would say it's like slightly higher than its yearly lows. Yearly lows are around maybe 9% vol. Currently it's trading at 12, so it's slightly higher. Now I also want to show something around all the option chains that are available here. So let me get my pen out here. I want you guys to focus on this number here, the 12, 11, 13%, and that's what the market is perceiving this product to be in the future, in the coming months and weeks and days. Meaning, from now till our go-to position will be in this market in the 35 days out, 35-day expiration, which is giving us an 11% vol and a very small percentage of movement. So 2.95% move, meaning that this product is what the market is perceiving based on volatility. It will move 2.55 points from here. So it will go up 2.55 or can go down 2.55. So what we need to make sure is like we covered this much expected move. This is the expected move on this product. So the further out you go in expiration, you will see that the volatility is pretty flat, right? It's not pumped in yet because overall vol is pretty low. If you want to, if you look at VIX, it's down at the bottom right now. So overall vol is low. So here the expected move is up because you have more time. You have more time in the expiration. So looking at the bond market here, the 30-day bond market, and I was just showing you the overall expected move, which is in the bracket here, this side, and then the implied volatility of this product is here. So looks like the implied vol is around 11 to 12%, which is good, which is fine. I mean, all this means is like, there's not much volatility out there in the market because the market is up so much. If you look at the VIX chart, I don't think you will see much fall anywhere. It's down another 2 points today, 2 points and 22 cents. Just right at the bottom. The average is probably 16, and it's trading at its average, below average, like it's trading at 14. So what this means is like we need to be careful with these products. Usually we sell in high vol, but because volatility has jumped up in this 30-day bond market, 30-year bond market, so I don't mind taking a position here. Now remember, every tick is worth $15.625. So let's see how many ticks can we actually collect in this market today. Usually I will give you my average. I collect about 10 to 11 ticks, and then that's where I sell it. So I'll sell it for like 11 ticks, and then I'll buy it back for 5 or 6. So I make about 5 to 6 ticks profit on maybe on a $350 initial investment. So let's take it back. So let's say if you make 5 ticks, which is $15.65 each, and you deposited $350 to trade this, that's 22% return, okay, just on this trade. Now, if you annualize that number, meaning if you can keep doing this, if you keep doing this, that's a good annualized number. But here's the problem with the annualization. You don't always get the opportunity to get into the market throughout the year. There's only certain periods of time where this product offers high vol, and that's when you get in, and then you get out when the vol is taken out of the market. So let's go to our go-to spot, which is 17 delta here. Good IV and good volume. So I'm showing you like the three, how to survive the 3 losing trades by going into a trade as a risk-defined strategy. Okay, so this is a risk-defined short put spread strategy, meaning the one way of not losing your mind on these is to be risk-defined. Like I said at the beginning, if you're a beginner or an intermediate trader, you should always be risk defined. Most of the time, 60 to 70% of your portfolio should be risk defined, no more. Okay, so 17 delta, and I can sell this as a vertical. Okay, let's take a look at the analyze tab, see how this works for us. So yeah, 1 tick out is totally fine. Now we're not collecting enough here. At max we will probably collect 8 ticks, which is probably low for me. It's not enough. One tick wide credit spread, I would have liked this number to be around 10. Like I mentioned before, I sell it at 10 and then I buy. So this number should have been at 10. And then buy back at like maybe 6 or five, even five. So you make 5 ticks in the spread. But right now, it doesn't look like there's enough credit available, enough volatility in the part. And the only reason this is down to 8 is because there's not enough vol out there. So this is the problem in the low vol environments as for option sellers, because that's our edge. We consider high volatility to be our edge, and we always abide by that. I'm running a research piece where I'm going to show you how this trade has actually turned out in a high vol or a low vol environment. Okay, and I'm hoping to see the difference between the success rate, high success rate in high vol, and low success rate in low vol environment. So, I mean, we will not take this trade today because it's trading at 7 ticks. I don't like this. This should have been trading at about 10 or maybe 11. Okay, at that point, you would have collected $171. But look at the amount of money you're putting down, around 334. So that's my go-to strategy. But then you also have to pay some commissions here, 450 minus another $3 or $4 each way. So it's like $7 each way. So that's $15 out of your pocket or your profit before you even make any money. So you have to consider that. The futures options market provides good capital efficiency because you can collect $150 by just putting down 350. So that's good leverage, good capital efficient, good use of your capital. Versus if you were to do this trade in the TLT market, which is the underlying ticker, which is the underlying F for the 30-year bond for the bond market, 20+ year bond market, you would have paid about $1,000 or maybe even $2,000 to do this kind of trade to collect this much money. Okay. Now that's the reason why I stick to futures options, because it provides you the best allocation of your capital in terms of how much you're putting down, how much you're collecting, how much you can actually take home. So looks like this trade's in. Did we put this in? Oh yeah, it's working. But look, I'm trying to collect 11 ticks. It's trading at 7. It will never be filled. So I'm going to cancel this order. Okay. And then I would just like show you how, what I would have done if the volatility would have been higher. Anyway, risk defined, that's the number one thing. I was actually showing you the volume and open interest. Here, look at these columns, and then look at these columns, volume and open interest. Always high volume, always stick to high volume and high open interest strikes and expiration cycles. Now, these numbers should be in thousands, which is what they are. So we are very comfortable going into this product because look at the bid and ask spread, only 1 tick. So you're only giving up 1 tick to trade this product at the level that we are trading. It's 2 ticks now, but it was 1 tick. The further out of the money you go, tighter it gets. It's good. There is liquidity throughout. You can just check. Ask here. There is liquidity throughout. Now, the second thing I wanted to discuss is diversification in your portfolio. So you don't want to just trade SPY or S&P 500 futures, which are coming up here. They're up like 100 points right now. So you don't just want to trade this. Futures options market gives you exposure to like at least 10 different products. Meaning, let me show you this. So there's this currency market, which is Aussie dollar, British pound, Canadian dollar, European dollar. Oh, sorry, euro. Euro is my favorite product. British pound is good too. Aussie dollar is not that bad. Then there's Mexican. There's then Mexican peso and some other smaller currencies too. Then there is the oil market. Then there is the indices market. Then there's gold. Then there's natural gas. The major indices are all there. Nasdaq, Russell 2000, silver. In the metals market, it's gold and silver. Then you have the VIX products are there, and then you have the interest rate products. These are the main ones that I trade. And then the ag market, which is where soybeans and wheat is there. So you have at least good 10 to 12, 15 products that you can trade. But remember that these are highly correlated. What do I mean by that? So 30-year bond market and the 10-year bond market is very highly correlated. So you will see that in your positions. So ZB and ZN probably, or ZF as well, which is the 5-year market. They trade, almost with a very high correlation. I don't exactly know that number, but it's a very high correlation. So it's good to diversify your product line, your portfolio, and that's how you avoid the losing streak. Now, another thing I didn't mention was it's good to like get in that trade when I mean, I would have never taken that trade at 7 ticks. I would have waited for this vol to like jump up a little bit and then go to my target price, which is 10 to 11 ticks. Some people would have taken it, and then the volatility would have gone up, shot up, and then they would have lost in trade because you're short vol in these put spreads. And every time you sell an option, you're short vol. So just be mindful of that. Have your price targets in mind, meaning every product that you trade, every stock, every ETF that you trade, you should have a price target in your mind. For example, if I was trading an Apple put spread, what would be my price target for the $1,000 that I'm putting down? So let's take a look here. So the Apple market has good expiration cycles, everything. Let's say if you take the 56-day cycle, good open interest, nicely done. Yeah, my 18 delta short put vertical. So a couple of things here in order to avoid the losing streak, or in order to avoid losing trades. Always trade with one, however much your account can handle. I don't go over 2% of in each trade, 2% of my notional portfolio. So for example, if my portfolio is let's say $5,000, minimum example, each trade would not be more than maybe in a small portfolio, maybe 4%. So maybe 5%. So here's a problem that you run into. You cannot do naked options here because you need a lot of margin. Okay. So what we do is like you can trade a $5 spread, $5 wide spread, but then it just depends on how your account, how big is your account and how much risk can you actually take. Don't take more risk than you can actually bear. Always my advice. So let's say this is 1018. So let's change this. Okay, this is the curve that you have. You have 78% chance of winning. That's a good percentage. But again, the vol, if you want to look at the volatility here, there's not much vol. It's like, at the bottom, which is fine. I mean, the vol doesn't jump. I mean, 80 to, maybe 70 to 80% of the time, the vol doesn't go up. So you do, if you are doing something, if you want to stay engaged, what do you actually do? In that case, I stick to the futures options market. I don't go into the equity markets. They are, more volatile than the overall futures options market, which are, slightly, I would say less on the lower volatility side. So anyway, this trade is the max loss is 439. Just look at here, $439. You're collecting 61. Now 61 again is a very low number. I would have collected at least $1 somehow, and that can only happen if you go $10 wide. So at 205, instead of 205, you go 200. So sell at 210, buy back at 200. That gives you $1. You see this? But then that increases your risk. Now you are $900 max loss, which is fine if you want to do a $10 wide spread. I would have avoided this kind of trade in individual equities, and I would have done a spread in a futures options market, like I said, like I showed you. So you can do at least two of those for the price of one that you're paying here. What do I mean by that? So you're putting down $895, which is $900, right? That's $895. Yes, you pay less commissions. That's fine, but you can do two of those trades in the futures options versus one of these. So your capital efficiency goes up by 2 times. Because you can make twice as much money there for the same kind of exposures. Diversify your portfolio as well. So you can take one trade in the bond market, the other one could be in the oil market or something else. So always keep an eye on that. This is how you actually stop losing trades, meaning you go in as credit, risk defined. Make sure you go in at the right time, not at the bad time, and always, know how to adjust the trade. Now, we've not talked about adjustments here because I don't have any, we haven't really put the trade on, but the adjustment would have been for me, the way I just put spreads is I go in at when it reaches, I sell at 17, and if it reaches 30 or $35, so if it would have been up here, then I would sell the call side to collect a little bit more premium if I have enough days left in this cycle. If I don't, then I would just roll the credit spread out, to the next cycle. But I will not wait until it gets in the money. In the money is too close to the market. 30 to 35 delta is when I would take action in this market, and then I would roll this this is a 56-day cycle. I'll probably roll it into the 90. At that point, this 91-day cycle is sitting at maybe 60 days again. So you roll it into that, collect more premium, adjust your strikes a little bit, and then just sit on that trade. Because then at that point, if the market has breached or is close to your short strike, now you are defending, the trade. So the objective is to either, at least break even, make some money on the, in this trade, and then buy it back. But like I said, look at these futures options market. If this interests you, drop me a comment, like whatever. Just let me know if you want more information on these markets. I can provide more color, more mechanics, like how does each market work, what is the tick size, all that kind of stuff. But take a look. It's not scary. Futures options market is not scary. It's a lot better than the equity markets. They're more liquid. The main ones are very liquid. So take a look. Let me know and hit subscribe if you like the videos. Thank you very much. Bye bye.